Hello, ladies and gentlemen. Welcome to the Q4 Market Outlook video here at Capital Financial Group. I'm Alex Leonida. I run the investment strategy here at CFG, and I'd love to share some of our observations of what's happened so far this year, give a breakdown of current events, and then finally wrap up this video with an outline for asset allocation strategies moving forward and some of the things that we're implementing with our portfolios here at CFG. So without further ado, let's get rolling. We got US stocks up first. You guys know this chart. You've seen it numerous times. These are the major indices that we track here in the United States. We have the Dow in our purple. We have Russell 2000. Those are the small companies in that gold color. We have NASDAQ in the blue, and then that fancy lime green is the S&P 400, which we just use as a mid-cap index. Both small and mid-caps are still negative on the year. Not something we necessarily expected after such a challenging and volatile environment last year, especially this deep into the year with tech shares still kind of leading the way. As far as market breadth is concerned, the story is pretty much the same, not quite as dramatic as it was earlier in the year that we discussed, at least in our Q3 video, where it was roughly 8 total companies driving 90% of the return in the market. It spread out just a little bit, but we was able to find an interesting chart here that gives us a cumulative breakdown of the weighting and of the top 10 stocks in the S&P 500 as a percentage of total market capitalization in the index. Even with this bump in participation over the last couple of months, the top 10 stocks are at the highest percentage of market capitalization in history, which is a long time. Moving on, internationals and emerging markets in particular have given back basically everything that they gained earlier in the year. Internationals are still up just a touch on the year, a little south of 5%. There's been a lot going on overseas, a little bit more dramatic in terms of volatility than what we've had here in the United States, which probably seems kind of wild because it feels like there's been a lot of volatility here in the US. But ultimately, the European Union is back in a recession, which we predicted earlier in the year as a very high likelihood given their data and the trajectory of things happening in Europe. In the emerging market space, the big story, per usual, is China. They have massive defaults looming with the real estate market. We had this same issue back a couple of years ago, if you remember, right at the tail end of Q3 2021. All sorts of drama with the real estate market and the over-leveraged building of empty buildings over and over again. That has reared its ugly head again, and we're seeing some stress on financial markets in China. Fortunately or unfortunately, depending on which way you like to look at it, that is a very captive, closed-off economic environment. While there can be some contagion risk in terms of international investments, most of this is going to fall squarely on the Chinese government, as they are the ones driving the spend in infrastructure and housing development across their country. If that's not enough, we've had quite a bit of drama in terms of war. Obviously, we know what's been going on in Ukraine. We're going to touch on that a little bit later. And there's been recently a new violent outbreak here in the Middle East with Hamas attacking Israel. We're going to get into how that might impact financial markets and what that might look like for portfolios here in just a few minutes. Also, moving over to the fixed income space, bonds began to stabilize earlier in the year. We kind of outlined this in our last video. Positive return, nothing to write home about, but was getting a slight recovery relative to the bloodbath last year. They've given all of that back and then some. The three indices that we look at are the US Ag, the Global Aggregate, and then also the Bloomberg Municipal Bond Index here on this chart. They're all negative at this point. This would mark effectively the only time in history we've had 2 full calendar years with all of these indices down in the same year. Once again, we're in one of those history is a long time type of scenarios. In effect, I've actually read that the bond market hasn't gone through a stretch like this some in some 200 years. I don't know how accurate that is because my data doesn't go back that far, but I believe I read it in Forbes. So look it up, kind of wild, all things considered. While you've been trading in a range for most of the year, yields have broken out to the upside again. Most of that is a product of the inflation that we've seen during the third quarter. It's been a bit stickier and a bit more resurgent than a lot expected. We also saw energy costs jump up again with some of that unrest in the Middle East. Also, Saudi Arabia has been cutting oil production. And of course, there's still the situation going on with Ukraine and Russia. Shouldn't even call it a situation. Obviously, it's a war. But in any event, still affects global energy, transportation, and costs. At this point in time, what we're focusing on is a very important number on the 10-year yield, which if you've been following us in the past, you know is probably the most important treasury, at least that we look at, because it has far-reaching ramifications, especially in the mortgage and lending space. And the 10-year just touched 5% last week. It's been hovering somewhere above 4.5 for the last couple of months, but it broke out to the upside, which signaled some fairly substantial sell-offs in bond markets. It also would lead us to believe that the Fed may actually not hike interest rates again before the end of the year, as the bond market has already priced this in and built in significant upside and additional rate hikes into the yield curve at this time. Any way you slice it, yields are quite high, maybe not on historic standards, but in modern history, say call post 2000, the 10-year is at the highest level it has been since 2007, which is pretty significant because we've been in a low interest rate, high liquidity environment essentially ever since then. In lieu of making a bunch of predictions on stocks and bonds and where they're going from here, I think I've made my point clear in the previous videos, so if you haven't watched those, please check those out. I'll just give it a quick little synopsis. I think bonds are going to be stronger here moving forward, especially into calendar year 2024. And I expect additional volatility in stocks, which we've already begun to get here at the beginning of Q4. Let's talk about a couple of things that are at least top of mind for a lot of clients, and I've fielded some calls and had some solid conversations about. And the first one is the government shutdown looming and all the dysfunction in Congress. What I have here is I found a pretty cool little chart that shows a list of all of the government shutdowns since Vietnam. Essentially, most of them are very, very short, but these aren't terribly uncommon. I know people talk about it, how it's just a massive breakdown in communication and nobody can work together and yada, yada, yada. But the bottom line is we kind of do this a lot in the United States. This seems to be a way that people think they're going to get something done or get concessions in one way, shape, or form. They also don't really last very long. I mean, a lot of these right in the middle stretch, at least from the 80s into the mid 90s, were just a day or two. Ultimately, we don't particularly care about these government shutdowns. I mean, it would be nice if it wasn't happening because it is kind of embarrassing. But in terms of the stock market itself, it doesn't really move much because all these really mean is that the government's going to furlough some non-essential employees and basically give them a long-term paid vacation, hopefully not too long-term, but in the case of 2019, the most recent one, that was kind of long. It was a little over a month. Everybody pretty much just didn't go to work, and then they got checks for back pay as soon as the government opened again. Also, really important to point out with these government shutdowns, not that we've had one yet, but if we do, the government still pays their interest on treasuries. This is not a situation where we will likely see any kind of default, even though it doesn't necessarily look good from an optics perspective. Moving on to the bigger one is that's going to be the war in Ukraine. Obviously top of mind for a lot of folks. It's drug out for much longer than I think most of us expected. Although if you go back to a blog that I wrote in the spring of 2022, I pointed out this could be a very long drug out thing, especially if the United States gets involved. And we have been involved, at least almost making this look like a bit of a proxy war. There's really minimal effect on global markets from this. I think that has been definitive over the last 18 months, give or take. And really all we've seen is some food cost and energy cost disruptions causing some issues in supply chains, primarily in Europe, but a little bit less so across the rest of the world. The next big one is the conflict between Israel and Hamas. This one hits a little closer to home for most of us, I would say, especially because Israel is a very close ally of the United States. But ultimately, the markets just don't really care about this kind of thing either. Found this awesome chart breaking down what has happened over all of the semi-recent to recent conflicts in Israel. And what we're seeing here, without oversimplifying it, is that the market doesn't do anything, especially over the short term. There's been a couple of moves at or near double digits, but generally speaking, the average of this is essentially nothing. The market just doesn't care. Taking this one step further, our friends at JP Morgan put together this incredibly complicated chart, but it's been highlighted in blue, and what it shows specifically is what happens leading up to a geopolitical event or conflict. That's the blue line left of the dashed line, and then what happens after the geopolitical conflict on average. Obviously, there's lots of outliers on this chart. There's been some crazy up moves and down moves, depending on which data point you're focusing in on. We didn't break them down. It would have made the chart a little bit too hard to look at, I think, if it isn't already. But ultimately, what we see is there is a trend that is created through natural macroeconomic movements in the market. Markets price things 6 months to a year in advance, so they slowly move in that direction. There is, boom, an event, that's the dotted line, and the market may fluctuate slightly, but ultimately continues on whatever that trend line is. I guess all I'm getting at here is that the market is going to do what the market's going to do, and if there are meaningful ups or downs, following the most recent events in Israel, it likely wasn't because of Israel. It was because of macroeconomic data that's coming in much higher or lower than was expected. Now it's time to get into our investment themes going into the winter months. We're going to start with bonds. This is not common for us, but big talking point, especially with the 10-year hitting 5% last week. They are enduring a historic drawdown, and we're poised to overweight some bonds. It's one of those whole buy low, sell high strategies. We're also keen on extending duration a little bit to take advantage of potential peak interest rates at this time. In terms of U.S. stock exposure, it's going to remain generally higher quality and a little bit of a focus on dividends, which isn't terribly different from where we've been all year. I just think some of that AI-fueled speculative rally has kind of lost steam at this point. We've seen that with some additional volatility, especially in the tech space over the last couple of months. With a challenging third quarter behind us, we think that might continue into the fourth quarter and even possibly first quarter of 2024. Internationally, we've already reduced some exposure to the European Union and emerging markets. That will likely remain the case between now and the end of the year. And precious metals still have a place in the portfolios. Both individual stock strategies and diversified ETF models both have precious metal exposure and will likely continue to have that exposure, at least until we think there's more stability on the horizon, or these precious metals have reached the end of their super cycle. As with all of our strategies, it's extremely important to point out that none of this is a recommendation to buy or sell. We manage everything on discretion here, and we make changes constantly and are constantly monitoring and updating our strategies. Nor is past performance a guarantee of future results. And for more specific ideas and explanations on how these themes are being applied in your portfolios, reach out to the team at info@CFG Financial Planning .com for a review. If you're not a client and you would like a complimentary portfolio review, do the same, info@CFGFinancialPlanning.com. It is free and well worth your time. If you enjoy these updates and you want to make sure that you always get them in your email inbox, remember to like and subscribe to this video. Thank you all again for watching, and God bless.